Today we are looking at Pfizer Inc. ticker symbol PFE. What we're going to be doing is looking at the fundamentals of the stock to then give a fair value based on discounted free cash flow and the Warren Buffett intrinsic value calculations. But first, let's just quickly have a look at the stock price. You can see it is around about $48 a share, up 10% on yesterday. Look at this bullish price movement through both of these 50-day and 100-day moving averages. And you can also see in the MACD, the signal lines have crossed recently, and we have very strong technicals. But we are not here to look at the technicals. We're here to look at the fundamentals of the stock. So Pfizer currently has a market cap of $272 billion. It has a share price of $48 a share, 52-week low of 33 and a 52-week high of 51.86. So still a little bit away from its all-time high. Currently pays a very healthy 3.21% dividend, and the ex-dividend date is in January. So first, let's have a look at the PE ratio. Is the PE ratio less than the market? Yes, it is, 14.43 to 28.5. So that is a pass. Next is the revenue increasing. It's gone from 53 billion to 63 billion. So that's very good that the revenue is increasing. Next is the profit increasing. Yes, doubled in that time, 11 billion to 19 billion. You can see the revenue's only gone up by about 10 billion. The profit is increased by that, but obviously that is almost doubling in the profit. So can we get a like on the video? Can we aim for 20 likes for $20 billion in profit? Next, we want to look at the shares outstanding and are Pfizer buying back their shares? Yes, 6 billion to 5.5. So that is excellent. They're buying back their shares and rewarding shareholders. Next is the free cash flow increasing. No, it's not. 14 billion to 11. So that is a negative, and that is the final check, and that is a fail, but not the end of the world. So you can see that Pfizer currently has 4 passes. As I said, 1 failure on the increasing free cash flow. Free cash flow ratio of 23.47, which is a lot higher than the PE ratio, and it pays a $8.7 billion dividend, which is less than the free cash flow, but not safe, but not necessarily the safest dividend. I don't think they're going to have any worries paying this out, but you can see that it is getting relatively close, and with this decreasing free cash flow has been a worry, but let's see what the models say. So first, we want to look at a discounted free cash flow model. This calculates the future free cash flows and then creates a terminal value of the company. And based on discounted free cash flow, we can see that Pfizer has a calculated stock price of actually around $81.69 cents a share, which will be currently at a 68% discount. So discounted free cash flow model loves this stock. Then we want to look at the Buffett-Graham intrinsic value. What this will do is create an intrinsic value based on the earnings per share and expected growth rate. Pfizer has an earnings per share of 3.37 and an expected growth rate of 10%, and that would give a fair value of $96 a share, which is good because it's very in line with the calculated stock price, and a Graham price, which is obviously the Ben Graham price. This is a price where if you wanted to see the stock at this price, you would buy and hold, and it is a very safe price, and they value it at $72.54 a share, which is also a buy. So both models are really liking the stock. You can see that it's valued well below this price with $48 a share, and this is saying that the price should be anywhere between $72 and $96 a share. Right guys, thanks for watching. Please give a like on the video. Trying something a little bit short today. Tell me if you like it down in the comments, and I'll catch you guys next time.